Welcome to Trader TV, your insight into trading for professional investors. I'm Dan Barnes. Joining me today is Kevin McPartland, Head of Market Structure and Technology Research at Coalition Greenwich. Kevin, welcome back to the show.
Dan, thanks for having me.
So today we're going to be discussing what's been going on in the Treasuries market. We're now halfway through the year, and the US Treasuries market saw a lot of activity last year, some concerns as well. Just looking at bare numbers, what sort of activity have we seen this year?
Yeah, it feels like we've really hit an equilibrium in the post-pandemic age. If we look at electronic trading levels, they're effectively back to where they were, at least the top line numbers are. So in May, we recorded 62% of notional volume traded electronically. If we look at just the dealer to client activity, it's at 51%. And again, both of these numbers are at historical norms for the most part. Average daily volumes in May were $565 billion a day. Again, also within that sort of $500 to $600 billion range. If you think about that in contrast to last year, in that first week of March, the average daily volume was over $1 trillion a day, which was just unprecedented. So we're back to normal. And even volatility, remarkably low. If you look at the MOVE index, which was at about 55 or so in May, that's up only about 3% from May 2020. I think the one big change that has persisted, order book volume has now sort of lowered to be a smaller proportion of overall electronic trading from where it was pre-pandemic. I'm not sure there's still really an answer to that, if that is still cyclical and the cycle is just long, or there is some structural change that's gone on, but that should, play itself out over the coming months.
I think last year there was some speculation as to whether some of the electronic liquidity providers had changed their strategies on the basis of the volatility we saw back in March. It has been a long time since then, so it would seem perhaps that is not one of the drivers.
It's still hard to say. I mean, volatility has still remained low, despite what I would think is a lot of uncertainty in the market in terms of market direction. That said, the Fed has still been so clear as to what its expectations were in terms of bond buying and interest rates. So I think that's left market participants feeling comfortable that the markets will stay where they are for the time being. And maybe that lack of volatility has still kept some folks out of that portion of the market that were otherwise there before.
One of the other big issues we've seen in Treasuries, of course, and the wider fixed income market is changing regulation. There's been proposed changes to making firms register if they are trading systems, trading platforms, and some changes to supervision in that area. What sort of sentiment do you think is out there in the market for this?
The sentiment seems to be that there is more appetite for change. In a study we did a couple of months ago, we asked buy-side Treasury traders if they thought the market could use some more regulations. The results really were mixed. It was about half and half. Some thought we could use some more. Others thought we were fine where we are. Really what has changed is now that Chairman Gensler is looking over the SEC, it'll be interesting to see what his priorities are. There's obviously a lot to do with the SEC between the issues around, GameStop, crypto. We're still not sure how high fixed income will come up on the priority list, at least in the first year. It's certainly on the list, but whether they'll really tackle those issues in 2021 is still to be seen. But yeah, the big issues, I think clearing for treasuries, it's not a new issue, but it seems to have bubbled back up in importance following the market volatility that we saw in 2020. So I think we'll see a lot more discussion on clearing, whether it should be incentivized more or even mandated. That seems unlikely, but certainly something that's on the table. And then the other is regulating ATSs in the Treasury market a bit more. So if we think about equity markets and how they are regulated as ATSs, even in corporate bonds, right? We have registered ATSs, but the Treasury market has been exempt. It still is until now. So that proposal was actually floated before the administration changed over. It's still out there. I think there's general support for that idea. But of course, the devil will be within the details for things like what is the volume threshold that makes a venue have to register with the SEC as an ATS. So I'm sure some of those details will be debated quite a bit throughout this year.
The point about clearing, of course, is that it potentially reduces the risk-bearing nature of the sell side. If they're not carrying risk on their books, then potentially they can provide more liquidity into the market. And that was the real issue that people saw in March, and that seems to be one potential solution. So it will be interesting to see whether or not the market comes back following the SEC consultations with a positive response to that, I think.
Yeah, sure. And it also, in theory, could make it easier for all participants to trade with one another, right? Without a dealer being involved, right? If you're trading anonymously, because all of the flow is cleared, in theory, that opens up more access to all trading for all counterparties. Now, the buy side, generally speaking, has resisted trading in order books, trading anonymously in treasuries. They like the liquidity they see in name disclosed protocols, which still really do dominate, right? RFQ, especially over the last year, has really shown its staying power and its dominance in the treasury market. That said, if everything or most things now become cleared, it certainly changed the swaps market in a major way. It'll be interesting to see if that happens, what it does for treasuries.
Oh, definitely. We did see Lael Brainard propose that all-to-all trading in treasuries could be a solution. So it'll be very interesting to see if that potentially does develop.
Yeah, and I'm not convinced just because the market is big enough and liquid enough to see all of this trading in an order book that's really what the market wants. I think the fixed income markets specifically has shown that it appreciates flexibility in trading mechanisms, trading protocols, how to interact with counterparties. These are big institutional trades. This is not an equity market that has such a big retail presence, right? So flexibility, I do think, is key. But whether or not that flexibility will drive up anonymous trading, I think is still to be seen.
That's great. Kevin, thank you so much.
Dan, thank you.
I'd like to thank Kevin for his insights today, and of course you for watching. To catch up on our other shows or to subscribe to our newsletter, go to tradietv.net.